The U.S. housing market appears to have reached a turning point, and the long-anticipated real estate crash could be starting. Much of what I've been covering in previous videos has pointed towards this, and we could be in for a wild ride for the rest of 2022. Let's not waste any time, get right into it. The June monthly real estate data from Redfin, a national real estate brokerage, was recently released and showed the median home price in the U.S. is falling. Yeah, that's right. The median home price in the nation overall was $413,000 in June on a seasonally adjusted basis, down from $414,000 in May. Now, you're sure to be saying, wait a minute, that's just $1,000 less. What's the big deal? At pretty much any other time, you'd be right. But it's what's underneath this top line number that shows the housing market turning. And it's gotten to a point where it started to show up in the headline median price number for the nation overall. This is a big deal because the U.S. median home price has increased every month since May of 2020 on a seasonally adjusted basis, and that decline was only due to the pandemic. Before that, we hadn't seen a month-over-month decline in Redfin's seasonally adjusted data since December of 2016. So this is not an insignificant occurrence. Let's run through the supply and demand data so you can see the confirmation of some trends I've spotted for you in previous videos so you can see for yourself this market is turning. Let's start with demand because that is where things are breaking down the fastest. Home sales appear to be collapsing, coming in at the lowest level of transactions since June 2020 when real estate activity temporarily plummeted in the beginning months of the pandemic. This is a confirmed downtrend at this point, nothing temporary about it, and I'm expecting these trends to keep heading lower. Pending home sales, which are the best predictor of closing sales in the next month, continue to trend lower. Aside from the level of transactions showing weakness in demand, we're also seeing a continued downtrend in the quality of successful offers. The sales to list price ratio hit 101.2 in June on a seasonally adjusted basis, the lowest level since April 2021. At this pace, it won't be long before homes are selling below list price on average, and then we will really start seeing median home prices heading much lower. Another statistic showing how the quality of offers is on the decline is the percent of homes that reduced their price in June. It hit 14% last month, which was the highest since October 2019, basically the worst it's been even since the pandemic started. We've seen this metric heading higher since June of 2021. Add it all up, and we're seeing a major turning point in housing demand, which has finally reached a point where we're seeing nationwide median home prices on the decline. So that's the demand side of the market. Now let's take a look at the supply side and see how we're doing there. The number of new listings is not showing homeowners racing to sell their homes while prices are at their peak. And we're seeing the most movement in the number of current listings. The current inventory of homes on the market, not counting new listings, is noticeably higher from the pandemic lows, and June was the fourth month in a row that inventory has been rising. From the previous charts, we know this isn't due to a surge in new listings in previous months. It is because of collapsing demand and transaction volumes heading lower. This is clear when we look at the month supply of homes, which measures how fast the current inventory of homes on the market would be exhausted at the current pace of sales. And because sales are heading lower, we're seeing this metric reach the highest level since July of 2020. What I've tried to do when it comes to an outlook for the housing market is to put together a range of scenarios of what could happen, depending on what happens with inflation, how the Federal Reserve responds to inflation. That's because what the Federal Reserve does on interest rates will impact mortgage rates, which will impact housing demand. We're already seeing mortgage applications plummet in response to rising rates. A report released this week from the Mortgage Bankers Association showed that mortgage applications are at their lowest level in 22 years. Housing demand is all about affordability. If mortgage rates keep rising, housing prices will have to come down for people to afford a home. Could I be wrong in this approach that focuses primarily on housing demand and not supply? Sure. But given what's currently happening, I don't think I am. See, as mortgage rates have been rising, we've seen the average housing payment, calculated with a 30-year fixed rate mortgage, hit 38% of the average household income in June, which is at historic unaffordable levels. And what has happened along the way? Adjustable rate mortgages have become much more prevalent in mortgage applications, hitting multi-year highs in 2022. When we calculate affordability based on the lower rate on an adjustable rate mortgage, the average housing payment is coming in at 34%, but it's rising too. My last video on inflation highlighted how we just hit a new multi-decade record high, which means the Federal Reserve is likely to keep raising rates, meaning mortgage rates are likely to keep heading higher in the months to come, whether we're looking at fixed rate or adjustable rate mortgages. There's just not much more buyers can do to make their housing payment more affordable. I'm looking at this slight downtick in the U.S. median home price as the beginning of a major turning point in the U.S. housing market, given what we're seeing in the underlying data on supply and demand. Looking ahead to the next data point coming in to show us where all this is headed, the Federal Reserve will wrap up their two-day policy meeting on July 27th with a press conference from Jerome Powell that same day. We'll see how worried they were about this month's hotter than expected inflation report based on how much they raised the Fed funds rate. A 75 basis point increase is what most people are expecting, but I have a feeling they might push for a full 100 basis point increase because of the strong inflation report we got this month. We've already had one Fed official come out and state he was open to a higher than 75 basis point increase, and Treasury Secretary Janet Yellen, herself a former Federal Reserve chairwoman, has stated that inflation is unacceptably high. Lately, the Fed has dropped hints of what it is going to do before their policy meeting so they don't shock markets. So we'll be on the lookout for more public statements in the days to come leading up to next week's policy meeting. Shortly after that, I'll be releasing my monthly update on housing crash scenarios that incorporates all the latest data from the previous month. We'll see how my housing scenarios are shaping up and whether we're more likely to see a shallow or a deep correction of home prices, or if we're facing a full crash in housing prices. In between these releases, be on the lookout for more regional market analysis where I look at specific metropolitan level markets to get a more granular analysis of U.S. housing. If you want to see those videos as they come out, make sure you're subscribed if you haven't already, and hit that notification bell down below so you know right away when those come out. And if you could give this video a thumbs up to support the channel, help it grow, it would be greatly appreciated. Thanks for stopping by. I'll see you in the next video.